You're still tuned in to News and Views with myself, Salailo Makwidiri. We're going to be turning our attention now to the pulse of the nation, the economy. According to fresh data from StatsSA, real GDP rose by 0.5% in the third quarter of 2025, July-September, marking the country's fourth consecutive quarter of growth. And on the production side, 9 out of 10 industries expanded, and this is led by gains in mining, agriculture, and trade, catering, and accommodation. Notably, mining output grew by 2.3%, powered by platinum group metals, manganese ore, coal, chromium, and copper production. Yet, not all sectors saw growth. The electricity, gas, and water sector contracted, shrinking by 2.5%, reflecting lower electricity production and consumption. So, growth, yes, but mixed. And the big question remains, what does this really mean for South Africans? Are we seeing the beginning of a meaningful recovery or just a temporary blip? And to help us unpack that is StatsSA Chief Director for National Accounts, Dr. Bokang, Vumbukani-Lepolesa. Doc, thank you so much for joining us on Salar Media. Really appreciate you giving us your time and looking forward to unpacking the numbers of the country's economy.
Good morning, Slyle, and thank you very much for having me.
I think let's jump right into it. To start with, how significant is this 0.5 quarter-on-quarter growth for South Africa in the current economic climate for ordinary South Africans? How should we be receiving the news?
Okay, so the first point to take home is that it is a positive, and we all agree that any positive must be celebrated, right? Now, when you look at the margin, we will notice that it is slightly lower than what we had in the previous quarter. But if you look at what we had in the first quarter of 2025 and the last quarter of 2024, we'll notice that we are still relatively better now with the results we have for quarter 3. So in a nutshell, what this means for us is, yes, it is an improvement, but if we were to compare it to what we had previously, we're slightly worse off now, but because it is a positive one, we have to celebrate it either way.
On sectoral performance, it was noted that 9 out of 10 industries grew in the third quarter. Could you take us through which sectors drove the growth and which sectors' contraction is the most worrying?
Yeah, so in this quarter, maybe the point to make firstly is that in the previous quarter, we had a similar situation where only construction contracted. Right. So this time around for quarter 3, we are seeing a contraction in utilities, which is electricity, gas, and water. And if we are to put it in numbers, we saw an increase. I think when you started, you mentioned that it was 2.5% contraction. That's correct. Is this worrying? What this means is that we are using or producing less, or we produce less electricity in that specific quarter. So what should be worrying is whether or not our industries are able to function, those that depend on electricity. But from what we're seeing, all industries expanded. And what I think maybe the viewers and listeners, what would have been of interest with regards to electricity would have been the issue of load shedding. But if you recall, the months for quarter 3, which are July, August, September, we didn't really have a lot of load shedding in that period. So it suffices to say, yes, industries were able to operate. However, we are seeing less production of electricity. But we must just bear in mind that, and this is the reason why we shouldn't really worry much, we must just bear in mind that we are reporting for a quarter that is following the winter season. So we do take into consideration the seasonal factors when you do adjustments, but what this means is that there was less production and therefore less usage of electricity. It could also be that we've become more efficient in the use of electricity, and therefore, the consumption is relatively less. But what we need to be happy about is that at least the industries are able to produce.
And I think that's very, very important to note. And one of the industries that I think it's important to focus on, because it has been the backbone of our economy for a very, very long time, is mining and primary industries. Mining output rose by 2.3%. From what I've read, this is led by the platinum group metals, among other things. What does this tell us about demand, about exports, and just the global commodity markets, and how sustainable is this growth trajectory trend?
Okay, so mining is an interesting one. Maybe let me start off by indicating that even in the previous quarter, we saw an increase. So just to put it in numbers again, we saw mining inquiring increase by 3.5% in the previous quarter. However, that growth has since slowed down to 2.3, as you've correctly indicated. And what becomes important is that to note is that the mining commodities are more for export, if you think about it. So I know that many people were worried about the tariffs and the impact thereof in everything. And but what we need to remember is that when it comes to tariffs, I know we haven't measured the impact specifically, but when it comes to mining commodities, metals, and all that, these are largely exempt from the tariffs. So at this point, it suffice to say, we cannot say that we expect the trajectory to continue, because obviously we are not forecasting, but the numbers are showing resilience in the sector. So more so, because why I brought the issue of exports is because many people expected that we would see a decline in exports, and specifically looking at the mining commodities, would see a decline in the production of the mining produce at large, but we haven't seen that, and we are not expecting the mining industry to be affected, extensively by whatever is happening in terms of the exports. But what is important to note is that the industry itself is very dependent on the global markets, because, as I said, we export, and that export means that our role to export means that we are price takers. We cannot determine what goes into the market, but we rely largely on the commodity prices globally to see whether or not we can export. Will then depend on the prices at large from the global market.
I want to focus on another interesting aspect: trade, catering, accommodation, and agriculture. There's been registered strong growth among those. Does this reflect increased domestic consumption, or is it more structural? For instance, post COVID rebound of some sort, government spending, or other factors that are involved?
Okay, so trade specifically reflected we usually gauge it from the demand side of things. We usually look at it from the household consumption, to say whatever is being consumed from households is coming out straight out of the retail, right? So we have seen an expansion in trade, but this was not just for households or retail; it was specifically for wholesale. It's a mix of things. So it's wholesale, retail, motor, accommodation, and food and beverages. And we are seeing the same sort of story when it comes to household consumption, because household consumption expanded. We know that previously we saw it growing by 1%, and this time around it is expanding by 0.7% and contributing largely to the expenditure side or the demand side of things. And when you look at what households are spending on, we note that the expenditure is cross-cutting. But maybe before I dive into the details of what people are buying, let me indicate that when it comes to household consumption expenditure, we have seen consecutive growth across the year 2024, and now we could say, short of quarter two, we are almost on the second year of consecutive growth, positive growth rates in household consumption. And we primarily say this is because we largely attribute it to perhaps low interest rates. You might have noticed that for a considerably long time now, we have had low interest rates, which typically mean that people have got money. So there's more liquidity in this, what people are able to spend. There's ease of, credit acquisition and all that. So people are literally able to spend. So now looking at what exactly people are spending on, In the quota that we are reporting on, we saw an increase across all items that households spend money on. These include food, alcoholic beverages, housing and water, furnishings, and all that, health, education, except clothing and miscellaneous goods and services. We may recall that the issue previously was, what is miscellaneous goods and services, and why was it contributing largely? So this is where we have things like insurances and all that. But what we saw in quarter three is that contrary to what we saw in the previous quarters, quarter three reported a decline or a contraction in spending on miscellaneous goods and services, as well as clothing and footwear. The rest of the categories or items that people spend on expanded, with the largest contribution coming from transport. So in the third quarter, we saw a lot of transport expenditure, specifically by households. So that's in a nutshell how things have panned out. But when it comes to general government services, government spends on goods and services as well as salaries and wages. But what we saw controlling or driving the growth that we saw, an increase that we saw in general government services, was the increase in employment. We had a number of notable EPWP initiatives which somehow led to growth in employment.
I want to move on to production to people aspect of things. On the expenditure side, household consumption and fixed investment contributed to growth, but the private sector fixed investments rose only marginally. Does this suggest that you and I, ordinary South Africans, are the ones that are carrying the growth on their back, and business confidence is still a bit fragile at this point?
Well, when it comes to investment, I think this time around the fixed investments were actually a good surprise, a nice surprise to all, because as you may have been aware, we had a series of contractions. I think we only had an exception in quarter three of last year, where we only saw a positive growth of about 0.2% in gross fixed capital formation. But since quarter three of 2023, all the way until the last quarter, we saw decreases and significant ones. And that has been a worrying factor across the board. But we saw things turn around this time, where across all the areas that we put on in investments, there was just one which was linked to construction, which is residential building contracted, but the rest of the items that we report on increased. So it is not so much of household carrying the economy; it's a mixed bag. So as I'm saying, the investment is one example, and it's actually a nice surprise for everyone, I think, this time around. And when you look at or unpack it further, you'll note that previously we had reported decreases in investment by general government as well as public corporations, but private investment had increased. Whereas in the first quarter of the year, we had a reverse. General governments and public corporations had invested relatively more than private businesses, because the private investments had decreased at that time by 6.3%. However, what we are seeing now is a cross-cutting increase in investment. So general government invested or increased investment by 6.6%, and that was the largest increase. Public co-ops increased by 3.5%, and private investors then contributed or expanded their investment by 0.1%. So if you look at it, that holistic increase in investment in fixed capital formation contributed to what we are seeing now. So it is a mix of investments from across all enterprises and all the players, government and private, and also people being able to spend. And also because we have been able to export. Recall, when we have a lot of production, we are able to export a lot. And I think agriculture contributed largely to this. So because we're able to produce for local and international consumption, we kind of balance some things. So it's not necessarily households that are carrying, but it's all different aspects of the economy from the demand or expenditure side that contributed.
Lastly, before I let you go, Doc, I want to look at the outlook going forward. Given the 0.5% gain in the previous quarter's growth, do you see 2026 as a turning point for the economy? And what indicators should listeners watch in the coming months to gauge if real meaningful recovery is underway?
Okay, so we unfortunately do not predict, so we never really provide forecasts. But what happens is people tend to follow the monthly indicators. We do have, monthly indicators that we use to compile our quarterly numbers. So I think for people to get a feel of what is to be, they can start following, the details of the monthly indicators. We'll have details on what is manufactured, what is being sold on retail, as an example. So there will be something on trade on a monthly basis. So I think as time goes and in each of the months that we report on these indicators, people can then start following those just to have an idea of the likely direction. So what we must also bear in mind that it's not everything that we will be seeing in the monthly indicators that determines the future of for our number in the next quarter. So there are other aspects of the numbers or the estimates that are not necessarily in the public domain on a monthly basis. Examples include, issues on finance data. We never ever have data on a monthly basis on finance. We only get to release it on once a quarter. So, but in the meantime, people can just take stock of what is happening on a monthly basis on other things. And not forgetting that there are other things like finance which are not necessarily in the public domain and they may not necessarily be able to see. But what people must also check is issues around spending. Obviously, we are moving into festive now, and typically anyone would expect that people will spend a lot. But whether that is going to be the case and whether or not people have money is another factor that you need to think about. So I guess we'll just have to wait and see what transpires in the numbers for the fourth quarter.
There you go. Thank you so much, Dr. Bokang, Vumbukani-Lepolesa, for shedding light on these latest GDP numbers, breaking them down for us. Really, really appreciate you giving us your time. They have it. So while 0.5% growth in Q3 offers, I think, a glimmer of hope to some extent, especially with growth performances in mining and agriculture. I think trade also is also in the mix. The contraction in electricity, gas, and water is still a very, very concerning one. But yeah, I think, as Dr. Bokang says, whatever little glimmer of growth is there, it should be appreciated, but I think the consensus is it can definitely be more. 0.5% is not enough looking at the rate of unemployment in the country, and poverty, people still living in poverty. We need to be growing at least 1% or more to make sure that people get into jobs, young people especially. So yeah, we'll be watching closely if these are just the green shoots of something a bit more comfortable, or a start of sustained growth that delivers real, I think, felt uplift for ordinary South Africans, which is the most important aspect of economic growth. The numbers are one thing, but if you and I are not feeling it on a day-to-day basis, that's cause for concern. Going to take a quick break. News and views continues after this.